Welcome to this workshop, Beware the Media, Managing Emotions in Challenging Times. I am Janelle Cross. I'd like to acknowledge that much of this workshop content is from a presentation called Media Replay, produced by one of our investment partners, Hartford Funds. Let's get started. Today's headlines may seem scary, so scary that playing it safe may seem like the only rational strategy. However, most headlines aren't exactly new news. In the past few decades, we've seen repeating patterns of crises. Let's look at some headlines from the past. How about Social Security's coming crisis from the Washington Post, September 1974? Or No Way Out of This Unemployment Crunch, published in March 1983 in U.S. News and World Report. Or Warning, Further and Maybe Bigger Federal Bailouts Ahead, from Time Magazine, December of 1989. Despite all these recurring crises, the market has continued to rise. Recognizing most news isn't actually new is one thing, but more important is recognizing how these headlines influence our behaviors. Let's talk about how headlines drive our emotions, cause us to make mistakes, and what we can do to keep emotions and mistakes at bay. The news is here, there, and everywhere. Our 24/7 news cycle makes it easy to get caught up in the crisis du jour, and that negativity can fill us with worry and anxiety and change our outlook for the worse. Today, more news is viewed on phones than televisions. We basically have a media whirlwind in our pocket every minute of the day. This provides an almost immediate record of what's happening around the world. And since we are basically a society of ambulance chasers, the more sensational the headline, the more it sells. We also consume more headlines than ever before. A Nielsen study revealed we watch over 30,000 minutes of news a year. That's over 500 hours of headline consumption. This constant onslaught makes it difficult to distinguish fact from fiction and to maintain perspective. And while not all news is bad, since negative news sells better, odds are you're consuming more minutes of negative news than feel-good stories. During the early months of the COVID pandemic, 91% of U.S. news headlines were negative. That's compared to 54% in the foreign press and 65% in scientific journals. But our pessimism as a nation seems to be more of a habit than a response. From 2009 to the beginning of 2020, we experienced the longest bull market ever. During most of that bull run, though, most Americans believed our economic situation was negative. It took 7 years of strong market performance for most folks to adopt a positive outlook. But maybe we can't blame it all on the newsmakers. Psychologists and neuroscientists argue that humans seek out news of dramatic negative events because our brains evolved in a hunter-gatherer environment where anything perceived as threatening had to be attended to immediately for survival. So even if we know gloomy headlines lead to stress and worry, negative market and economic times seem to drive us to consume even more news. So far, we've established that we are hardwired to seek out the negative, and news outlets use that against us by publishing a disproportionate number of gloomy headlines. And this makes us feel bad, but it's worse than that. What we hear in the media can influence our thoughts and lead us to make costly mistakes that impact our financial future. When exposed to a steady stream of negative news, investors worry about losing money, and that fear hangs on long after the crisis has passed. And I know this is another busy chart, but let's walk through it. This is a look back from 2007, before the financial crisis and the subsequent Great Recession, through the end of 2020. The value of the S&P 500, this blue mountain, grew to reach record highs. Remember, from 2009 to the beginning of 2020, we experienced the longest bull market ever. But while the S&P was doing its thing, the world continued offering up bad news, like the flash crash when the Dow Jones Index dropped almost 1,000 points in a single day. There were government shutdowns, the North Korean missile crisis, interest rate hikes, and despite it all, the S&P 500 marched on. But many investors focused on playing it safe rather than growing their money, and investors missed out. This red line represents the amount of money investors pulled out of stock investments. In fact, investors withdrew $2.3 trillion from stock mutual funds over this period. But the S&P continued to offer up returns to those investors brave enough to stay their course. From the end of the financial crisis through the end of 2020, the S&P index value rose more than 600%. Most of the money investors pulled from stock funds went to bond funds, which are generally less volatile. But some took those dollars and put them in cash instead. But how safe is cash? Total assets in cash investments reached an astounding $15.8 trillion in 2020. While money in the bank gives us a sense of security, when our interest earnings are measured against inflation, they can be less reassuring. In fact, after considering inflation, CD investors actually lost money. The reality is, if you're going to be an investor, you must figure out how to avoid making mistakes. Markets will go down, and they'll go down more often than we'd like. In fact, during a 40-year career and a 30-year retirement, you may experience as many as 12 bear markets. So the question isn't if you'll face a bad market. The question is, how will you react? Since 1960, we've had 10 bear markets. 7 saw drops of more than 30%. Those included the Vietnam War period, when interest rates rose above 9%, the Middle East oil embargo and Watergate in the 1970s, Black Monday in 1987, when the Dow Jones Industrial Average fell 22% in a single day, the 9/11 terror attacks and the dot-com bubble, the collapse of WorldCom and other corporate scandals, the financial crisis, which introduced us to the concept of too big to fail, and of course, most recently, the COVID pandemic. When the market drops, the urge to panic can be intense. But if you sell when the market is down, you lock in losses. And to make matters worse, many investors don't find the courage to re-enter the market until things have improved. Put another way, until after the markets have gone back up. Despite the recycled newsreel predicting dire global catastrophe or the end of the world as we know it, financial markets have been resilient. During these last 10 bear markets, a $10,000 investment in the S&P 500 would have grown to nearly $3.9 million. A less aggressive balanced investment would have grown to over $2 million. Even a low-risk bond investor would have grown nearly $1 million of net worth. The investor who hit the panic button, though, lost out. And the investor who kept their money safe in the bank missed out even more. I'm going to step out of the Hartford presentation for a moment to talk about behavioral finance. Behavioral finance focuses on how individuals make decisions. Classic finance and economics assumes people always make rational choices based solely on optimizing outcomes. But we know our emotions and psychology also influence our decisions. Behavioral finance is the consideration of the ways these collectively influence us. Our personal biases and beliefs heavily influence our predictions about the future. For example, the theory of loss aversion suggests that most people prefer avoiding losses to acquiring gains. Fear of loss causes us to overlook growth potential and makes us more likely to sell when the market is falling. That same fear will probably have us sitting on the sidelines as the market recovers. Since 1926, the S&P 500 index has had 70 positive years indicated in green, nearly 3 times the number of negative years. Another bias worth mentioning is recency bias, which leads us to overemphasize recent experiences when making predictions about the future. In other words, the COVID pandemic bear market, although very short-lived, seems like only yesterday, which can make us more likely to forecast bad markets in the future. So what can we do to keep our emotions at bay and avoid making mistakes? First, go on a negative news diet. Unless you look for it, good news can be hard to find. For example, odds are these 2024 headlines missed your radar altogether. Scientists reported the ozone layer is healing faster than expected, marking a significant environmental victory, according to CBS News. 24 states raised the minimum wage, potentially improving the financial situation for millions of Americans. An AI-driven chatbot was created to provide educational access to millions of children who cannot attend school due to conflict and crisis. Significant AI-driven strides have also been made in the medical field, showing promising results for early lung cancer detection and more targeted treatments for depression and anxiety. Next, get your investment portfolio off the media go-round. The repeating patterns of crisis reporting make it easy to lose sight of long-term goals. Sensational breaking news stories coupled with our innate uncertainty tests our resolve. Assess your stomach for investment risk, independent of current events. Work with an advisor or use online tools to build a diversified investment portfolio, and then trust that strategy. Don't turn over the keys for your financial future to the nightly news anchor or that friend or family member who's all doom and gloom. And when tough times come, as they surely will, remember tough times don't last, but tough investors do. A bad trading day makes a good negative headline. A few bad trading days makes an even better one. But a bear market doesn't set in until the market's gone down 20% or more. Stocks lose 36% on average in a bear market. By contrast, they gain over 100% on average during a bull market. Bear markets tend to be short-lived with an average length of about 9.5 months. That's significantly shorter than the average bull market, which lasts about 2.5 years. Now, bear markets are painful, but markets are mostly positive. Over the last 92 years, stocks have been on the rise 78% of the time. Half of the S&P 500 index's strongest days in the last 20 years occurred during a bear market. Another 34% of the market's best days took place in the first 2 months of a bull market, before it was clear that good times had returned. Markets rally without warning, and even bear markets offer up opportunity. This is why we believe that the best way to weather a downturn is to stay invested, since it's difficult, or maybe even impossible, to predict or identify a market recovery. As we wrap up, I'll share one of my favorite quotes with you. This one is from Michael Lewis, the author of The Big Short. How many times does the end of the world as we know it need to arrive before we realize it's not the end of the world as we know it? Never make an irreversible decision without talking to an advisor. We can help you sort through what you see and hear in the news. Being worried and nervous is completely normal, and as you saw here, we are bombarded with things that exacerbate those concerns. But we can help you stay focused on opportunity by building risk management strategies that give you confidence you'll be able to weather the storm and reach your long-term goals too. On behalf of the entire Align team, thanks for joining me.